afternoon, everyone. My name is Beata Javorcik. I am director of the CEPR's International Trade and Regional Economics Program. And on behalf of the CEPR, I would like to welcome you to today's event. It's my great pleasure to introduce today Professor Silvana Tenreyro, who will be our speaker. Silvana is an external member of the Monetary Policy Committee at the Bank of England. She's also Professor of Economics at the London School of Economics. She is a Fellow of the British Academy and Associate Editor of the Quarterly Journal of Economics. And it's particularly great for me personally to have Silvana with us because she is one of the leading women economists in the world. And we are a rare breed, so it's great to see women in very prominent positions. Silvana will speak today about international trade, global supply chains, and monetary policy. You will have a chance to ask questions after the lecture is over. Please type your questions in the Q&A and I will read them to our speaker. So Silvana, without further ado, the floor is yours.
Thank you very much, Beata. Good afternoon, everyone, and thank you for having me here today. It's great to give a speech at CEPR, which has been a fundamental pillar of economic research over the years. As it did during past crises, CEPR has played a key role during the COVID pandemic in facilitating the two-way exchange between researchers and policymakers. The speed with which CEPR has been able to bring high-quality research to the attention of policymakers, including via VoxEU blogs and through the new COVID economics publication series, has been especially useful during the pandemic. My speech today is on a topic we have been hearing a lot about recently. I will talk about international trade, global supply chains, and their implications for monetary policy in the UK. I will first discuss some of the reasons for international trade and how the increased development of global supply chains has increased the scope for trade. In the context of recent disruptions to some global supply chains, I will then examine past crises affecting trade volumes and will compare these to the trade disruptions during the pandemic. I will finish by explaining what I think this means for monetary policy and setting out how I see the current economic outlook. I will make three key points today. First, international trade brings benefits in the form of higher productivity and increased average incomes. The development of global supply chains has allowed further gains to be realized. While in the past, there have been questions over whether trade and global supply chains also have costs by increasing income volatility, recent evidence suggests that trade can also reduce income volatility by allowing countries to diversify their risks. In general, trade and supply chains have proved resilient in the face of crisis. Second, recent disruption to global supply chains has arisen because of an unprecedented combination of a strong rotation in global demand towards some sectors, mostly goods, and away from others, mostly services, alongside a variety of reductions in supply affecting a few critical inputs. The rotation in demand reflects changes in consumption patterns brought on by the pandemic, which made some types of consumption less desirable given the associated health risks. It has also been influenced by the large fiscal programs in place in a number of countries. On the supply side, many of the reductions have also been COVID-related, with lockdowns taking place across the world, while several other reductions in supply have been more idiosyncratic. Third, in the UK, the economy has still not recovered to the employment and output trends we would have seen without the pandemic. At the same time, a range of temporary factors have been pushing CPI inflation above target and will continue to do so over the coming months. Some of these, such as base effects and the direct impact of energy price rises, are short-lived, and monetary policy can do little to offset them. Much of the effect of policy will not come until after their impact had faded. So I would tend to pay more attention to possible indirect effects on real incomes or on production costs. The effects of supply chain disruption should also be temporary and unwind as supply of some goods increases and as demand rotates back towards pre-COVID consumption patterns. The speed of this rotation is a key uncertainty and will be related to the evolution of the pandemic around the world. In the UK, domestic cost pressures will depend on the evolution of the labour market now that the furlough scheme has ended. My policy votes will aim to strike a balance between these different effects and risks while bringing inflation back to target sustainably. As you are all well aware, global supply chains have been dominating the news agenda. Just as the global financial crisis brought the financial system to the attention of the general public, as well as of many economists, so too has the pandemic moved the workings of modern supply chains from the background to the front page. But while the focus on these complex production networks is new, many of the debates hark back to some of the oldest questions in economics, the benefits and potential costs of international trade. International trade affects the daily lives of almost everyone in the world. In the UK, with around 1/3 of the consumer price index basket consisting of imported goods and services, our typical shopping basket will look very different without them. Trade brings many benefits. By allowing different countries to specialize in products they can produce more efficiently, it increases average productivity and incomes. We can also purchase more varieties of the same products, French and Italian cheeses to supplement British ones, for example. And international trade integration can boost the productivity of UK firms, irrespective of whether they trade directly or not, in several ways. Firms learn from best practices abroad and adopt new technologies developed elsewhere. And also greater international competition favors more productive firms. The development of global supply chains, these production processes that use intermediate goods and services sourced from other countries, are a natural extension of this logic. A large share of trade has always consisted of inputs used in production, as opposed to imported final goods and services. But in recent decades, global supply chains have continued to grow in importance. This reflected large reductions over time in the cost of transporting goods, initially through industrialization. More recently, progress in information and communications technology has made it easier to transport ideas and hence enabling the coordination of work at a distance. As a result, supply chains have also become longer and more complex, with stages of production offshored or unbundled across various firms located in different countries. As a concrete example, all you have to do is look down at your smartphone. From design to finish, our mobiles have been designed and constructed using the flow and exchange of know-how and parts and components produced and assembled across multiple borders. To measure the increased importance of supply chains in international trade, there is a range of different metrics we might consider. This chart here shows that as a share of global GDP, intermediate input trade, here in blue, has increased far faster over the past 30 years than trade in final goods and services, in pink. We might also want to know about how exposed different countries are to each other, either to measure risks and vulnerabilities or to trace out how shocks in one region may transmit to others. These bilateral exposures are more complex to quantify. For example, we might think of a British car, say a Mini, as being produced in Plant of Oxford in the UK, because that's where the final assembly happens. But it is estimated that over half of the parts used in cars assembled in the UK are produced abroad. Even taking these inputs into account would miss links in the network. However, since each input may be produced using sequences of inputs from elsewhere, the engine could contain cylinders from Germany, containing pistons from China, and so on. To try to capture the indirect links in the network, in my work with Francesco Caselli, Miklos Koren, and Milan Lisicki, we built a quantitative model of trade with global supply chain networks for all countries using data from the 1970s to the 2000s. The model allows researchers to trace how economic shocks in one or more countries or sectors transmit across other countries in the network, and to study quantitatively how that transmission has evolved over time as countries and supply chains became more integrated. A more recent paper by Richard Baldwin and Rebecca Freeman proposes a measure of foreign input reliance based on gross or cumulative trade. This index gauges a total potential exposure to shocks emanating from abroad. Disruption to production or shipping from one country due to a COVID lockdown, for example, is likely to affect the total value of goods produced or shipped, irrespective of the source of the inputs. Both papers stress that the substitutability between different intermediate inputs, as well as the possibility to diversify suppliers, will influence how a shock in one country affects its trading partners, a point I will come to discuss below. As global supply chains have expanded the scope for international trade, many of their benefits correspond closely to those from trade in general. Supply chains allow even more specialization, again, increasing productivity and average incomes. Lower costs or higher quality inputs and a greater variety of inputs can do the same. Supply chains also offer more possibilities for productivity gains from learning and technology spillovers, including via activities like the sharing of blueprints or managerial practices. So trade and integrated global supply chains bring benefits in the form of higher national income. An important caveat here is that these benefits may not be evenly distributed across societies unless governments use the gains from trade to compensate any workers or consumers who lose out. Moreover, given the disruption we have seen to supply chains in recent months, it is important to assess whether there are other potential costs or risks. One possibility is that while trade and supply chains raise the level of income in an economy, they could also make it more volatile. This was once a widely held view by economists based on the idea that increased specialization in one sector, which goes hand in hand with international trade, increases the exposure to shocks to that sector. For example, the UK has long specialized in the export of financial services, which means the economy is likely to be disproportionately affected by shocks to the financial sector, as occurred during the global financial crisis. My own research has highlighted that there is an offsetting effect, however, which means that trade can actually reduce income volatility, and typically has done so in the past for most countries. In my work with co-authors, we explain how higher trade integration allows countries to rely on a more diverse set of suppliers as well as buyers. This reduces exposure to shocks to any single producer or country. So, for example, if the supply of labor falls in the UK, this has a smaller effect on our UK car manufacturer than it would for a firm with a less diverse supply chain, since the shock has no direct effect on the cost of its imported inputs. Other recent studies echo those conclusions. For example, recent work by Bank of England economists concludes that a blanket reduction in supply chain integration can be economically costly, while not significantly reducing economic volatility, and that reshoring production would increase aggregate volatility by reducing source diversification. This diversification channel also allows countries to pool technologies, as we saw in the recent example of vaccine development. Only a small number of countries witnessed the successful development of COVID vaccines, but a much larger number have been able to benefit from their discovery. How do the recent supply chain disruptions, which have dominated news cycles, fit into this framework? We have seen widespread supply shortages, bottlenecks, and transport disruptions over the past year. Some of the causes have been idiosyncratic, such as the grounding of the Ever Given ship in the Suez Canal in March. So the question is, have these highlighted additional risks or fragilities in global supply chains that negate some of their benefits? Well, this is possible, as I will come on to discuss. Many of the disruptions have been directly or indirectly related to COVID. As a shock that has been global in nature, it seems likely that there are limits to how easily its effects can be diversified away. To get some indication of how and how quickly those global shocks to supply chains might unwind, we may be able to learn from similar examples in the past. So I will now turn to how supply chains have behaved during previous crises. Doing so suggests that supply chain trade can be resilient in the face of large synchronized shocks. It can also help mitigate crises emanating from large supply disruptions in one region. However, there are no perfect parallels to the effects of COVID on the global economy, so there are limits to how far we can read across from previous examples. The world experienced a similar global trade disruption following the global financial crisis. This has been termed the Great Trade Collapse, and as with the financial crisis itself, it simultaneously affected countries worldwide. This chart here shows that the size of the collapse was a massive scale, comparable to what we've seen over the past 18 months. And that it affected large global supply chain hubs, including the US, China, and Germany, similarly to the rest of the world. It was driven in part by the falling global demand following the financial crisis, which impaired demand for tradable goods. In turn, this led to an unwinding of supply chains as intermediate demand also collapsed. Encouragingly, for the current situation, trade rebounded to its pre-crisis level fairly quickly after the financial crisis, as illustrated in this chart. This swift recovery may give us comfort that even when there is a global shock affecting supply chains, it can reverse relatively quickly. At a macroeconomic level, large-scale policy stimulus after the financial crisis helped reverse the fall in demand for tradable goods, with a consequent increase in supply chain trade. Many studies even suggest that supply chains helped mitigate the scale and persistence of the overall trade collapse, as supply chain relationships tend to be highly resilient. During the financial crisis, firms tended to maintain trading relationships, albeit at a lower scale, allowing them to quickly rebuild volumes as demand recovered. Looking to other more geographically concentrated disruptions, such as the 2011 Tohoku earthquake in Japan, reveals similar responses. Recent work by Front and co-authors zooms in on vehicle and electronic sectors trade, after the earthquake, and provides evidence that intermediate imports were significantly less affected compared to final goods imports. This past example suggests that there are some grounds for optimism about the resilience of supply chain relationships in the wake of the COVID pandemic, and about how quickly large global shocks can be reversed. But although also global, the COVID shock has differed from the global financial crisis a decade ago. The main difference is that although it had some supply elements, the financial crisis was primarily a large fall in demand below supply, including a reduction in the demand for tradable goods. In contrast, a connecting theme of recent supply disruption has been demand running ahead of supply for some products or sectors. This has had some demand side causes. COVID has caused a material rotation of demand towards goods and away from services where health risks are higher, which has increased demand for tradable goods above their pre-COVID levels. And this is partly illustrated in this chart, which shows the marked increase in global container shipping volumes, a reflection of the increase in tradable goods demand. Goods demand has been further boosted by large fiscal policy stimulus in advanced economies, particularly in the US. It has also had some supply side causes. Lockdowns and other health restrictions have impeded production or transportation in some regions, while the spread of COVID has led to isolation or health-related reductions in labor supply in others. And adding to these factors, a number of idiosyncratic and unrelated shocks to goods supply, for example, multiple extreme weather events occurring during the pandemic, or the grounding of the Ever Given, have contributed further to global imbalances in the goods sector. A second difference with the financial crisis is that the effects of the financial crisis were felt simultaneously around the world, while the COVID shock has been less synchronous. The spread of the virus has waxed and waned at different rates in different regions, as illustrated in this chart. Partly as a result, lockdowns and other public health interventions have also differed across locations across time. The relatively lower synchronicity during the pandemic has in all likelihood helped cushion in the impact of the COVID shock, as some countries were able to resort to imports from less affected regions abroad, and thus mitigate the impact of some product shortages in their domestic economies. However, the nature of the shock and the disparities in timing may have posed challenges to some supply chains. It is typically easier to recover demand than it is to increase capacity, as has been required for some goods and inputs. Furthermore, in long multinational supply chains, the way COVID has led to a series of regional supply and transportation disruptions may have had a somewhat more persistent impact than a single large shock. In light of the unique nature of the challenges during COVID and the recovery with a battery of different shocks affecting supply at different times, it is tempting to ask whether it has been an exception to the usual benefits of trade. The disruption has intensified calls for reshoring production networks, aiming to reverse some of the supply chain integration we have seen in recent decades by increasing firms' reliance on domestic suppliers. The question this calls raise is whether countries would have been able to tackle the COVID shock better without trade and without global supply chains. If we were to imagine such a scenario, it seems unlikely that the absence of global supply chains would have been beneficial. Given the link between trade and the level of income, a more closed economy would have initially faced a far more difficult task, with fewer resources available to help maintain incomes of workers and businesses most affected. Lockdowns abroad would not have affected production or supply chains domestically, but domestic lockdowns would have had a far larger effect. So although the timing would have been different, it's not obvious that the overall shock would have been smaller. In fact, the volatility induced would likely have been larger, since a smaller scale of domestic production in a closed economy would have made it impossible to shift to substitute suppliers. Losing just a few workers due to an event like an outbreak in a given plant could mean losing the entire production line of certain inputs or foods. Indeed, a number of the specific shocks and bottlenecks that are currently impacting output in the UK are at least partly domestic in nature, albeit we are seeing similar effects in some other economies. Shortages of truck drivers, for example, have been impacting logistics in the UK, most notably the supply of petrol. While this shortage has several discrete causes, it is difficult to see how any of them would be addressed with less international trade. If anything, it seems plausible that by enabling more diversification, supply chain trade could have mitigated the overall impact of the shock. Where producers had substitute suppliers in different regions, the asynchronous nature of lockdowns and other impacts of the pandemic may have enabled them to continue production when a supplier in one region was unable to satisfy demand. Clearly, there are areas where diversification has been more difficult. We have seen a range of transport bottlenecks reflected, for example, in increases in shipping costs. And echoing the financial crisis, the opacity of many production networks means that beyond their direct suppliers, it is not always clear to firms how diversified supply chains for different products are. Fundamentally, many of the current disruptions seem to simply reflect unusually large imbalances between supply and demand for some products and from some locations. COVID and its spread are the proximate cause of most of these imbalances. While there may be limits to the benefits of supply chain-driven trade in the face of such shocks, reshoring production in response would be a risky strategy, which would almost certainly lower incomes on average without necessarily providing any benefits in terms of lower volatility or more resilience in response to supply shocks. The debate is an important one to continue. However, with a higher risk of climate-related extreme weather events in future, it may be that shocks to supply chains become more frequent in coming years. So far, I have described what global supply chains are and why they have come to be so important to international trade, as well as some of their benefits and potential costs. But in the capacity in which I'm speaking today as an MPC member, the most pressing concern is the implications of global supply chains for monetary policy. There are two different categories of effects. The first consists of the various long-run impacts supply chain integration may have had on the structure of the UK economy and the consequences for monetary policy. These impacts, including on the slope of the Phillips curve and the degree of output volatility, have been covered extensively by former Bank of England colleagues, so I will not focus on them today. Instead, I would like to discuss the implications of global supply chain impacts on the near-term UK and global inflation outlooks. In the near term, the persistence of current supply chain disruptions is a key source of uncertainty for the inflation outlook. If the effects of supply chain disruption on CPI inflation are short-lived, then attempting to use monetary policy to offset them would only serve to impart additional volatility, since the effects would be fading by the time policy was having a major impact on inflation. Where the temporary effect is on the level of prices rather than its rate of change, that is inflation, then the disruption we are currently seeing would have a disinflationary impact as we progress later into our 3-year forecast. If, in contrast, supply chain disruption were to have a more persistent impact, it would play a larger role in my assessment of appropriate monetary policy. By simultaneously pushing down on output while persistently increasing inflation, it would create a trade-off between the MPC's objectives, which policy would have to manage. The MPC will be giving its collective assessment of the effects of supply chain disruption alongside the other factors influencing its inflation forecast in the November Monetary Policy Report. But for my own part, I would like to explore some of the factors that may determine how quickly disruptions will unwind for specific products. I will do so by using as case studies two of the most prominent examples of goods subject to disruption over the past 18 months, semiconductors and personal protective equipment. Semiconductors are a crucial input to a large number of industries, including cars and consumer electronics. Although the semiconductor industry accounts for a small share of GDP, many upstream buyers rely on semiconductors with no substitutable alternatives. As a result, a global shortage of semiconductors during the pandemic has had disproportionately large economy-wide effects. The shortage has been due to both demand and supply factors. On the demand side, a range of goods have benefited from a rotation away from some services, owing to higher COVID risks in the latter. But within that, demand for electronic devices has been particularly strong among individuals working or learning remotely. When lockdowns ended, there was also a sharp recovery in the demand for motor vehicles, given both pent-up demand and a COVID-induced preference shift from public transport towards private transport. Both factors have boosted demand for semiconductor inputs, leading to a sharp rise in sales, as illustrated in the chart on the left. On the supply side, global semiconductor production was hit by a number of idiosyncratic shocks. This included winter storms and power outages in manufacturing plants in Texas, a fire at one of the largest semiconductor factories in Japan, and a drought in Taiwan. Although semiconductors production increased over 2020, delivery times are higher than pre-COVID, while import prices have picked up, as shown in the chart on your right. The supply of semiconductors is typically slow to adjust to large shifts in demand. The manufacturing process is complex, and lead times, the wait between order and delivery, are long. The industry operates at large scale, is capital intensive, and requires significant R&D expenditure. As a result, significant investment is required to increase capacity. Given the increase in demand, new manufacturing facilities are currently under construction, but will take some time to come online and to be scalable. Moreover, even with increased production capacity, it will likely take time to fulfill current backlogs which have accumulated during the shortages. Let me now turn to personal protective equipment. PPE is a collective term used for wearable equipment and gear that protects users from hazards. As a key form of protection from COVID, the pandemic has led to an extraordinary increase in global demand for PPE, of which face masks have, of course, been the most visible type. This steep increase is clear in these charts, which show US imports of masks, respirators, and medical gowns. This spike in demand was also present in the key supplier of PPE, China, reducing net exports to the rest of the world, while some countries also applied restrictions on PPE exports. At the same time, supply was disrupted by lockdowns and factory closures worldwide. The combined effects of a rapid increase in demand alongside supply restrictions were amplified by the fact that the industry holds low levels of inventories. So available stocks were drawn down quickly when demand outstripped supply. Production of PPE is typically high volume, low value, and low profit margin, in part because the main buyers are cost-sensitive healthcare facilities. To keep costs low, PPE suppliers tend to use just-in-time inventory management, leaving supply vulnerable to shocks. Although the acute phase of the pandemic saw shortages for many types of PPE, some of these supply chain issues were solved fairly quickly as firms were able to increase production. As products with a relatively simple production process, it was also easier for firms to convert production or switch to substitute suppliers of some types of PPE than would be the case for semiconductors. Nonetheless, issues with some types of PPE persisted longer due to difficulties in sourcing inputs and the time and cost of bringing new capacity to market. An important consideration was that with much of the increase in PPE demand expected to be temporary, the return on any investment in capacity is a bit less certain than with semiconductors. So extrapolating from the case studies back to the macroeconomy, I draw the lesson that as supply disruptions feed through into price increases, supply can and will adjust in response, but the speed of that adjustment, and so the persistence of the price increases, is likely to vary across products. For simpler, more homogeneous goods such as PPE, where there are many suppliers and limited market power, supply may be able to adjust relatively quickly. For more complex goods, such as semiconductors, some disruption may persist into 2022. In determining the macroeconomic effect, the adjustment of relative demand for different products seems likely to be more crucial still. Even for goods such as PPE, where supply can adjust more quickly, firms will be less inclined to do so if the increase in demand is expected to be temporary. For items such as semiconductors, a fast rotation in demand back towards pre-COVID patterns has the potential to ease disruption more quickly than an expansion in supply. If so, there may even be the possibility of the price of semiconductors falling back if a reduction in demand meets greater supply. One source of the rotation will be as a response to price changes. As the global prices of goods subject to disruption rise relative to other goods and services, relative demand is likely to respond. These demand patterns have been also closely tied to the evolution of COVID, both in the UK and globally. When virus spread has increased, mandated or voluntary social distancing has led consumers to substitute away from riskier high-contact services towards goods. As a result, the prospect for a rapid rotation back towards services, and hence the persistence of supply chain disruption, will also greatly depend on how the pandemic evolves over winter and beyond. Finally, turning to the current outlook, COVID initially had a disinflationary impact on the UK and the global economy as weaker domestic and global demand led to declines in wage and price pressures. In contrast to the initial year of the pandemic, the uneven recovery is likely to create a temporary trade-off, which monetary policy will need to navigate. These inflationary pressures have given way to inflationary ones, while output remains a normal-sized recession below its pre-COVID level and further still below its medium-run trend. As I have discussed today, this tension stems partly from the various disruptions and bottlenecks currently affecting global supply chains, which are leading to temporary negative supply shocks in the UK. These disruptions have been driven in large part by the effect of COVID and the subsequent recovery on both supply and on the balance of demand between goods and services. In the near term, the inflation side of the trade-off will also be exaggerated by a number of temporary factors, which may not be informative about how prices are likely to change in future. In particular, base effects from weak prices a year ago have been pushing up on recent inflation outturns. And while inflation is likely to increase further over the next few months, a large part of this increase will come from the direct impact of higher energy prices. Increases in the level of energy prices are not typically a sign of future energy price inflation. So these tend to only have one-off impacts on the level of CPI. Monetary policy cannot offset these effects on inflation, which are driven mostly by global factors, because the level effects tend to drop out of the inflation calculation before policy can have much impact. It will, of course, be important to remain vigilant in case of any second round impacts of higher energy prices. These include the reduction in households' real income, which could weigh on demand and future inflation, and any impact of higher energy costs on firms' production costs, which they may ultimately pass through to consumer prices. The current supply chain disruption will also be ultimately temporary. For some products, disruption and its effect on inflation are likely to dissipate quickly as firms find new suppliers or current ones are able to expand. For others, where supply is slower to adjust, the rotation of demand from goods back towards services should help ease pressure on supply chains. In either case, responding to short-lived effects on inflation would only be likely to impart additional volatility. While my expectation is that the effects of supply chain disruption will be short-lived, a non-negligible risk is that the switch from goods back towards services is more protracted, leading to a longer period of supply disruption and inflationary pressure. Given the close relationship between the composition of output and COVID risks and restrictions, it is likely that the epidemiology of the pandemic across the globe will be crucial in whether this risk crystallizes. The other major uncertainty for the UK inflation outlook at present is the evolution of the labour market, where there are two-sided risks. Given the near-term outlook for headline inflation, there's a possibility that higher inflation or higher inflation expectations begin to feed through into higher wage demands. The effects of inflation expectations on wage bargaining can be difficult to gauge, so I will be paying particular attention to direct indicators of wage pressures, including our best assessment of underlying wage growth, settlements data, and information from the bank's agency network. The opposing risk is that the end of the furlough scheme in September leads to a loosening in the labour market and a moderation in wage pressures. A large number of workers need to be reabsorbed into the labour market over the coming months, some of whom will flow into unemployment. The literature on unemployment benefits, which are comparable in effect to the furlough scheme, would suggest that the furlough scheme has been pushing up on wage growth, so its withdrawal may well put this process into reverse. Along with my colleagues on the MPC, I will be weighing up these different risks ahead of our November monetary policy report. At the time of our August forecast, I expected that if the economy were to evolve as in our forecast, some modest tightening in line with our conditioning path would be required to achieve the inflation target sustainably. Since then, we have had large upside news for near-term inflation from energy prices, which should fade quickly. We have also seen a moderation in recent GDP growth, which looks set to continue as we enter the winter months, affecting supply as well as demand, as higher energy prices reduce households' real incomes and depress spending, with additional risks stemming from the prevalence of COVID in the UK and falls in income for any furloughed workers who move out of employment. Overall, I judge that the balance of this set of news is unlikely to have a large effect on the amount of tightening required over the next few years. The August forecast was conditioned on market expectations of a gently rising path for bank rates, gradually unwinding the relatively small amount of monetary policy stimulus added since the onset of COVID. They were also consistent with evidence that the medium-run equilibrium interest rate remains low and is likely to be so for some time. The precise path policy takes towards that equilibrium rate will partly depend on how the risks I have highlighted evolve. As always, my votes on any future policy changes will depend on incoming data and my assessment of the economy at the relevant MPC meetings. Uncertainty over the effects of the furlough scheme should be resolved over the coming months, which should help paint a clearer picture of the position of the labour market. We will also continue to learn more about the persistence of disruptions to global and domestic supply chains and their impact on the UK inflation outlook. I will pause here and happy to take questions. Thank you.
Thank you very much, Silvana, for this very comprehensive presentation. And a reminder to our audience, please submit your questions via Q&A. And it is quite helpful to us if you state your name and your affiliation. So Silvana, we have a couple of questions that relate directly to the points you have made during your speech. So the first one is about supply chains allowing for a more diversified set of suppliers. That's the point you made in your speech. But what about the situation when all of these suppliers are located in one country? And the second related question, would diversifying supply chains be more efficient than reshoring? So is reshoring the optimal response, or is diversification the way to go?
Okay, let me start with the last one. Reshoring means that you are exposing yourself to domestic shocks. So it's the opposite of diversification. Now, if you really think that you're not exposed to any shocks, weather shocks, or any other domestic hits to your economy, and you are perfectly safe, then reshoring might be the best strategy. However, and this is based on analysis of sectoral and country-specific shocks that many people, including myself and co-authors, have done over the past, suggests that that's not a good assumption to start the calculations. Diversifying suppliers, diversifying buyers allows you to hedge against those domestic shocks and that high exposure that you might find if you close your borders. So my answer, based on, again, the empirical data from the 70s to the 2000s and the work I've done with Francesco Caselli, Miklos Koren, and Milan Lisicki, that suggests that for most countries, including the UK, opening to trade and global supply chain integration has actually led to lower volatility through this diversification mechanism. For some countries that didn't happen, so I think the split is roughly 2/3 of the countries benefited from the diversification. For 1/3, that benefit was actually much smaller. But what's interesting is while diversification led to significant decreases in volatility, for those that didn't gain from diversification, the increase in volatility was relatively small. So anyway, what we do in that paper is precisely do that quantification that you're asking about, how much you gain from diversification versus or opening to trade or reinforcing your global supply chains. And again, you might argue that the past is different from the future, and in there, we can have a debate. My sense is that we will be much more exposed to weather related events with climate change, and it's not for granted that we will be shielded from those shocks in the UK or in any specific countries. So having that scope for diversification could be very helpful when facing those shocks. I think there was I don't know if I answered the first question. Exposure to one country it's obviously a problem, and that's why you want to really diversify suppliers widely if possible. That should be the strategy, and there might be losses in efficiency in doing that, but on the other hand, there are gains in terms of diversification. The work by Rebecca Freeman and Richard Baldwin that I cited, gives you a concrete index, and you can see the exposure to different countries. So, for example, for the exposure for of most countries to China has increased over time, and then you can see how much that implies in terms of domestic volatility from the perspective of a given country. And again, the model we have allows you to carry out those type of exercises. What happens if the economy becomes too concentrated on imports from one particular country, and how that impacts your volatility. Yeah, so the bottom line is reshoring would be very risky if and it would only work if you think that your economy can be shielded from any shocks, and I don't think that's a realistic premise to take policy.
Thank you very much, Silvana. So sticking with the theme of supply chain diversification, two more questions. Now, goods have become more complex over time. They often require a larger number of inputs, and these inputs require relationship-specific investment. And the question is, how can supply chain diversification offset the impact of the crisis in the presence of this relationship-specific investment when switching suppliers is difficult? And the second question, should governments play a role in easing supply chain constraints?
Okay, so the question, I mean, if you think it's very difficult to switch suppliers, then the scope for diversification is more limited. So what we see in the data, or we saw since the 70s, is that countries did indeed diversify the sources of supply, and that's what led to the gains in terms of reduced volatility. But obviously, if you think that the relations at the national level are very sticky, then that is a problem. But if you think that within a country you have a few producers and they maybe have different suppliers themselves, that's a way of diversifying from the perspective of a given country. So maybe the relations for one firm might be sticky, but taken as a whole, the whole portfolio of firms, they might have more diversification there. So it's an empirical question. And again, it will depend on the industry you are studying, the country you are studying, and there's no general. I mean, I'm just trying to highlight here the main trade-offs, but obviously the specific question with a proper quantification will depend on which products you're talking about. And should governments help? I mean, in some sense, governments can ease by supporting the economies during during times of crisis, as many governments did, easing or trying to act as a bridge so that struggles by one firm don't escalate to the rest of the network. So in some sense, by having counter-cyclical policies, you can help stopping or aborting the propagation of the shock. More specific policies, then you enter into the domain of industrial policy, and that's a trickier territory. I think this is where Beata will be able to say more than me. She's the expert. But industrial policies comes from the usual pros and cons, and it's the answer in the end again will depend on which sectors you're talking about and which countries. But I cannot give you a general answer on that.
Well, on industrial policy, right, countries can shape their trade patterns or their production patterns through investment promotion efforts. And the benefit of investment promotion, by which I mean provision of information and lowering bureaucratic barriers, the benefits of the policy is that it's cheap, it's effective, and there is little distortion if you get it wrong. But Silvana, let me take you to a bit more of a medium term outlook. So in my view, the next big thing that will shape global value chains is the effort to mitigate climate change. And I think it will have profound effects on global value chains through carbon pricing. So think about within the European Union, carbon prices have gone up. They will go up even further if we are to achieve the goals we set out to achieve. And that means that countries such as Poland, where 3/4 of electricity is from coal, may find themselves less competitive given their energy mix. Also, if you think about carbon border adjustment taxes, this will make exporting to the European Union, for instance, more difficult for countries where production is very energy intensive. If you look at steel, Russia has energy intensity 3 times as high as the European Union. Kazakhstan has twice as energy intensive production process. But on the positive side, access to renewables may become a new source of comparative advantage. So Albania, where 90% of electricity comes from renewables, may suddenly become an attractive manufacturing hub. What does this mean for the future trajectory on inflation and for your work on the Monetary Policy Committee?
Yes, so I mean, undoubtedly this will generate big changes in relative prices, and it might have big, level effects on prices. As to where this will be inflationary or disinflationary, the key question here is how will demand respond to this, big changes in technology, some of which will adversely affect some countries, and the others will be more positive from the perspective of, say, Albania. So, I mean, if you want to play with possibilities with me, I mean, one thing that you have to consider is whether, in terms of thinking about the response of demand to be these big changes, a key question is whether these supply changes are anticipated or unanticipated by consumers, governments, and firms, because that can make a big difference. At an extreme, if the process is fully anticipated and households, governments, and firms understand it, this might actually slow down expected income growth, and demand could contract in advance even, which would cause these inflationary pressures. At the other extreme, if the process is not factored in, not anticipated, and demand doesn't adjust, then we can have inflationary pressures. Actually, Diego Comín and Robert Johnson have a very nice recent paper illustrating these different responses of demand. Now, the role of monetary policy there is, again, to balance demand and supply, depending on how demand adjusts in response to these big supply changes that are coming. But I think it's very important here to think in terms of general equilibrium, because the partial equilibrium logic that globalization or or in this case changes in carbon prices might unambiguously affect inflation in one way doesn't quite go through once you work out the demand response. And this is again the point that Diego Comín and Robert Johnson are making. So again, we need to think about country by country, and country by country, try to factor in how demand will react to these big changes. And once you do that calculation, then the role for monetary policy is to try to balance demand and supply. So we will, as usual, be over time, estimating the supply capacity of the economy with these new changes, and based on those estimates and what we see on the ground in terms of demand, then the role of monetary policy will be to step in to keep inflation at its target. So we will see big changes in relative prices, and there will be big distributional effects and so on. I don't expect the remits of monetary policy committees to change, so there's no reason to expect in equilibrium a change in inflation across countries, because that's precisely what monetary policy will be doing, leveling demand against supply and making up basically any gaps that might open.
Thank you, Silvana. So now let's focus for a bit on the UK economy, and two questions. The first one, are you worried about the poor performance of UK exports and the record level of job vacancies? And second, how do the changes, both past and current, in international trade and global supply chains play out in different parts of the UK? So this is a question about spatial and social inequalities.
Okay, on the first question, I mean, we still have a big shortfall in output and employment in the aggregate economy in the UK. And once you start disaggregating output, exports as well. So, I mean, this is why monetary policy has been accommodative through this period. Obviously, the biggest role here has been played by fiscal policy in trying to support this transition out of COVID. So this is a key part of the thinking here. Job vacancies, it's in some sense. It reflects that the fact that a large number of workers in the UK has remained on furlough until recently. So the key uncertainty now is how that unwind of the furlough scheme will affect equilibrium outcomes, and whether vacancies will be filled by those workers, or whether we will see a period of unemployment and vacancies at the same time. There are clearly big imbalances in this in the recovery, because it has been so uneven, both the crisis itself and the recovery across different sectors. So it is in some sense not surprising to see this sharp increase in vacancies, particularly when you have many workers still locked in a relationship and through furlough, which obviously was a positive aspect in terms of supporting demand through the crisis. But now, as that is over, then the key question is whether we will continue to see those levels of vacancies, or whether they will be filled by all these workers entering into the into the market. Another obviously effect on the labor supply in the UK has been that some workers have left the labor force. I mean, this is normal in crisis that, to see exit from the labor force. And again, this is a key uncertainty, how many will come back and how much participation will react to the pick up in activity that we would expect to see. So there are big uncertainties, and in some sense the big numbers are not that surprising, given that the recovery has been so imbalanced and the labor force has been restricted to some extent. The spatial redistribution is a big important question. Is part of the bigger discussion on the distributional effects of trade and global supply chains, and the spatial dimension is an important one. Penny Goldberg made an interesting point. She argued in the Marcus Academy webinar that global supply chains allow for more spatial diversification, and that's a big source of redistribution. I haven't studied the work myself, and I haven't seen the numbers, but it would be interesting to check the numbers from Penny Goldberg and see how. I really don't know whether she had anything for the UK specifically. It was a more general point. But it would be interesting to explore. Again, her thesis was that global supply chains allow for spatial diversification, bringing redistributional benefits along that side. Having said that, as we know, the benefits from trade can be seized by anyone only if there is a system of transfers and that can compensate those who lose and who lose from opening to trade or from this global supply integration. So that to the extent that that wasn't there, it's possible that it led to some negative redistributional effects in many countries, including the UK. But I don't have the numbers, and I can't. I really don't know. I would go first for Penny and see what she has to say, again, being one of the experts on international trade at the global sphere.
Thank you, Silvana. So now let's think about the long term, the future of globalization. So 2 questions. Do you think that deglobalization and supply chain problems have already started prior to the COVID pandemic? And second, for the past several decades, globalization has been moderating inflation. Do you think that now we will see a reversal of this relationship? So international trade will be a source of upward inflationary pressures?
Well, let me start with the second, which relates to one of the earlier questions with carbon pricing. In some sense, the issue is very similar, and whether globalization is disinflationary or not, and the opposite for deglobalization. The key issue here is how demand responded to that globalization and how it will respond to deglobalization. And this again is the point that Diego Comín and Robert Johnson are making. It really depends on demand, how it reacts to this higher average incomes from a more global economy, or the opposite in this case would be how demand reacts to the fact that if without trade we will be poorer. And so is that adjustment, and partly depends on how forward-looking consumers and firms are, and how anticipated those changes are in their calculations. So that's the critical variable here and the critical consideration. The sort of partial equilibrium will say, okay, the first effect of globalization will be to lower prices of tradables, certainly, But I mean, that's again a relative price. The question is how that affects demand, because if you're thinking of globalization, it should give a boost to real incomes, and through that stimulate demand. So in terms of inflationary pressures at the end, it's a quantitative question. And then again, that's where monetary policy comes into play, balancing those demand and supply gaps that might open. So again, concretely on if you think that you're in a path of deglobalization, and let me sort of accentuate the premise, then what you would see is, an effect on demand contracting somewhat relative to your counterfactual without the globalization, and that should put downward pressure on prices. Where demand ends up sitting is a quantitative question, and then again, this is where monetary policy comes into play. On the question of where the globalization started, so my colleague Catherine Mann has a paper arguing that it has started. I have to say I'm less convinced. I mean, it's true that the number of new trade agreements has not kept the pace, but in some sense we're saturated on that dimension. She has other metrics to look at it. Listening recently to Richard Baldwin talk, I was struck because he was portraying a big increase in trade in services that is opening up now, and with progress in information technology, this could be a big development that could go against this idea that we are on a path of deglobalization. So I mean, I think it's an open question. It's conceivable that we saw some slowdown in globalization. Not sure I would call it deglobalization yet, but there are people having this debate at the moment. And again, the sort of picture Richard Baldwin was painting is one of potentially big increases in globalization through the services, which in some sense has not been fully exploited yet.
Thank you. So in the remaining 2 minutes, let me ask you the final question. Has conducting monetary policy become more difficult because supply chains are more complex, because trade policy has become more unpredictable as global trading rules have weakened, and because we can expect greater frequency of extreme weather events that will lead to disruptions? So in other words, is your job now harder than the job your predecessors a couple of decades ago?
All MPC members say that their jobs is harder than their predecessors, so why not say that? Obviously this has been a difficult crisis. COVID was unprecedented on many metrics. The hit to activity has been huge. I personally don't think that the supply chain aspect of it, the global aspect, made things worse. The opposite, in some sense. I've been trying to argue that to some extent it helped mitigate some shortages during the crisis at key, in key moments of the crisis. So probably that was in some sense helpful. But I mean, yeah, it's if you compare to the period before the financial crisis, clearly this has been a much more difficult and challenging period. And yes, I expect with climate change, extreme weather related events will become more frequent. That's what the scientists are telling us, and we need to be prepared for that. And I think that's where diversifying sources of supply as well as demand might become important. And from the perspective of monetary policy, again, learning more about rapid responses to this crisis will be a priority.
Thank you very much, Silvana, for a very informative and thought-provoking exchange. It was wonderful to have you with us today, and best of luck through steering the economy through these turbulent times. Thank you very much, and huge thanks to our audience.
Thanks, Beata. Thanks a lot.